This is your teacher Harisbet, and we are going to solve a question from O-level accounting 7707 or 0452 IGCSE paper February March 2025-22 question number 4. This is from ratios. Remember that ratio won't come in the paper, in your paper, but it doesn't mean that you should not solve it. Why? Because MCQs obviously will come from ratios. In May, June, MCQs will come. You have to prepare ratios, at any cost. So fourth question is of ratios. February March 22 is the paper. Inventory opening is given 5,500. Revenue, purchases, expenses are given. Inventory closing, trade receivable, trade payable, bank overdraft, capital. February March 25-22. Gross margin you have to calculate. Margin and markup. Margin is always calculated on sales. Markup is calculated on cost of sales. So I have to calculate first gross margin. So formula for gross margin is, or simple margin, is gross profit over sales multiplied by 100. So let's see what is the gross profit. Revenue, so there is purchases given. So we have to calculate the cost of sales first to find the gross profit, because gross profit is equal to, so gross profit is equal to sales minus cost, right? So what is the amount of sales? Let's see. The amount of sales is 1,12,000. Cost of sales is going to be, we will calculate cost of sales. That is opening inventory plus purchases minus closing inventory. Okay. Opening inventory plus purchases minus closing inventory. Okay. Let's see. The opening inventory given in the question is 5,500 plus purchases 68,200. Let me write it down. 5,500. 5,500 plus 68,200 minus closing inventory. So let's see what is the closing inventory. Closing inventory is given here 31st December 5,700. I will subtract 5,700. What is the answer? What is the answer of cost of sales? G-Sabha, she will get a star in this exams. It is also went in recording. 5,500 plus 68,200 minus 5,700. 68,000 is the cost of sales. Okay. So 1,12,000 minus 68,000, we will get our gross profit. How much? 1,12,000 minus 68,000, 44,000. Now I can calculate gross profit is equal to 44,000 divided by sales 112,000 multiplied by 100. I will find the gross profit margin or gross profit ratio, and it will always be written as a percentage. So tell me, 44,000 divided by 112,000 into 100. 39.28%. Okay. Oh, sorry. 39.28%. Okay. Next is the ratio we will calculate is regarding the profit margin. So first of all, how we are going to calculate profit? From gross profit, we have to subtract the expenses, which are 2,500. So we'll calculate the profit first. Gross profit minus expenses. Gross profit is 44,000 minus 21,500. What is the profit for the year? 22,500. So profit margin is going to be profit over sales into 100. Profit over sales into 100. Okay. Profit is going to be how much? 22,500 divided by sales. That is going to be 1,12,000 multiplied by 100. So what is the amount? 20.08 0.08%. Okay. So 20.08% is the profit margin. Now let's move forward. Gross margin we have calculated, profit margin. Now we have to calculate return on capital employed. The formula to calculate return on capital employed, अक्सर बच्चे गलती करते हैं तो इसको जरा you have to focus on that. The return on capital employed is equal to operating profit. It is profit from operation, not the profit for the year. But if interest is not given, then you can calculate directly. Otherwise, it is operating profit. So operating profit divided by capital employed into 100. Operating profit means profit before interest. And capital employed is equal to equity plus non-current liability or capital plus non-current liability. So if you just look at, let's see, that either we have interest given in the question or non-current liability, no. So it means that whatever the profit is basically the operating profit. The operating profit is 22,500 divided by capital employed is capital plus non-current liability. There is no non-current liability. Bank loan, debenture is not given. Sir, bank overdraft, that is a current liability. So capital is given 285,000. Yes. 22,500 divided by 285,000 into 100. So what is the answer? 7.89%. It shows, always remember that gross profit shows that how much gross profit you have earned in comparison to sales. Higher the gross profit ratio, better it is going to be. And it will increase if there is an increase in sales with the same cost of sales, or if there is a decrease in cost of sales with the same sales. All sales are increasing and cost of sales is decreasing, or cost of sales remains constant. Again, the gross profit will increase. Or we have purchased some cheaper suppliers, right? Then again, our cost of sales will decrease, or we have increased the selling price per unit, and that will result in increasing the sales. So the gross profit ratio will increase, right? Profit margin tells us your ability to control your expenses. It shows the efficiency and effectiveness of the business, right? So 20.08% is basically the profit margin. Return on capital employed shows how much return you are getting on your investment. That is 7.89% return you are getting on your investment. Investment means whatever capital you have employed in the business. Then inventory turnover ratio and trade receivable turnover ratio. So first of all, let's see inventory turnover. The formula is going to be cost of sales divided by average inventory. Cost of sales we have already calculated. It is with us, that is 68,000 divided by average inventory is opening inventory plus closing inventory divided by 2. So what is the opening inventory? Let's see. The opening inventory is 5,500. Closing inventory is 5,700. 5,500 plus 5,700 divided by 2. It is going to be 5,600, right? So what is the answer? This inventory turnover ratio answer you have to write in times. And trade receivable, trade payable answer is going to be written in days, right? How much? Sorry? 12.14 times is the answer. So it means, it shows that you are able to convert your inventory into sales 12 times, almost 12.14 times in a year, right? You are able to sell your inventory 12.14 times in a year. So the trade receivable turnover ratio, the formula is trade receivable over credit sale into number of days in a year, not credit sale over trade receivable. So let's see, the trade receivables are 16,000 and the credit sale, if not given, we will take sales as credit sale, 285,000 into 365. Okay, what is the answer? The answer is going to be in days. It tells that in how many days you are able to collect amount from your trade receivables. Okay, it tells the ability of the business regarding the collection from customers. So the lower the ratio is favorable because it shows that you are collecting the amount quickly within short days. And in order to improve the ratio, you will give discount to customers so that they will give us the cash quickly. You will charge interest on overdue account. The lower the ratio, the lesser will be the chance of bad debts also, because the customers are taking less time to pay back your amount. Yes. It shows that relationship with the customer is good. Sorry. 52 days. So 52 days is the trade receivable turnover ratio that we are taking. 52 days to recover our trade receivables. Then liquid ratio, quick ratio, you can see, or asset test ratio, current asset minus closing inventory divided by current liabilities. Current assets minus closing inventory divided by current liabilities. It shows the liquidity of the business, the ability of the business to pay back its current obligation very quickly. But it does not take into account inventory, because inventory takes more time to convert into cash. It is the least liquid current asset, right? So current asset minus closing inventory divided by current liabilities. The best ratio is 1:1. It shows that how quickly you are able to pay back your current obligations out of your current assets. So let's see. The current assets are inventory, trade receivables, and that's it. So if you add them up, 16,000 plus 5,700, this is 21,700, right? So I will do 21,700 minus 5,700, the closing inventory, divided by current liabilities. And there are two current liabilities, trade payables and bank overdraft. Can you add them up? 5,100 trade payables and bank overdraft is 6,890. So the total amount is 11190. 11190. So what is the answer? Yeah, 11990. Okay, so can you calculate it? You will write the answer in ratio 1 form. 1.33 ratio 1 divided by 119,990. Okay, the ratio is going to be 1.33 ratio 1 की form में आपने लिखना है. It shows that your liquid assets are 1.33 in comparison to your current liabilities of 1, right? So that is quite fine, because 1:1 is the best ratio. So 1.33 ratio 1 is also very good. So it means that you have capability enough to pay back your current obligations quickly. Next part is that Raja's profit margin has decreased over the past few years. It has taken Raj longer to collect money from trade receivable in 2024 than in the previous year. Explain how Raj lower profit margin may be linked to his trade receivable taking longer to pay. Okay. So it has been said that Raj profit margin has decreased over the past few years. How the profit margin used to decrease? It means that your expenses have been increased, and your expenses have been increased because your trade receivables are either has become bad debts, because of that the profit are decreasing, or because it has taken Raj longer to collect money from trade receivable in 2024 than in previous year. Our trade receivable turnover ratio has basically taking more time. Trade receivable turnover ratio will increase. How come it will increase? It will increase because when the credit sales, either the credit sales has increased, right? The ratio will automatically decrease because of the increase in credit sales, and the trade receivables are not increasing. Trade receivable will remain the same. In any ratio, numerator and denominator. If numerator will increase, the ratio will increase. If denominator will decrease, the ratio will increase. So it has taken Raj longer to collect money from trade receivable. What does it mean? Longer means the trade receivable turnover ratio increase कर रही है, decrease कर रही है? Increase कर रही है. So it means your trade receivables are increasing actually. Trade receivables are increasing because they are not making the payment on time, right? And also it shows that your sales are decreasing. So decrease in sales will eventually decrease in the profit, results in the decrease in the profit. And decrease in sales and increase in trade receivable also suggest that trade receivable are not making the paying the amount, so you have to give discount to them. And bad debts are also increasing. That will also result in the increase in expenses and lower profit margin. So this is how your profit margin is linked with the trade receivable taking longer to pay, right? So this is the reason that Raj lower profit margin is linked with his trade receivable taking longer to pay them. Next is Raj is considering paying more capital into the business to reduce the bank overdraft. Advise Raj whether or not he should pay more capital into the business. Justify your answer by providing points for and against. Right? So more capital, if he will bring more capital into the business, his own money will be at stake, right? And he could have loss also for that reason. He could have loss also because of that, and he has to suffer that loss. And the bank overdraft will definitely, he will be able to overcome the bank overdraft, but that is not because of the trading activities of the business. He has put his own investment at risk to decrease the bank overdraft. So we need to advise Raj whether or not he should pay more capital into the business. Justify your answer by providing points for and against. Against, I have said that his amount will be at risk, right? And bank overdraft will definitely be overcome because the amount he has invested in the bank will decrease the bank overdraft, and it will be easy for him. But there are some other reasons like taking a bank loan, selling non-current asset obsolete, receiving collecting the amount from trade receivable quickly. These are the points which will increase your overcome your bank overdraft without making investment in the business. Another point which come into your mind that Raj is considering paying more capital into the business to reduce the bank overdraft. So you should pay or not? If he will put his own investment, his capital will increase, but current assets will increase. So it means that liquidity position will also have a positive impact. So his liquidity will overall improve, and current ratio and liquid ratio will improve more and more, right? But the other side of the picture is that his own investment will be at risk, and currently he is not having any kind of bank loan. The business is not basically financed by the non-current liability. So it is better that he can go for a bank loan to reduce the bank overdraft. Okay, so this is how we are done with this question.